Question number 13. In case of proposed dividend out of post-acquisition profit, declared but not adjusted in the books, then how can we treat this post-acquisition profit? H Limited acquired 80 shares in S Limited when S Limited had 100 rupees in reserves. Right. So the ratio being 80% and 20%. Reserves and surplus 200 total, or capital profit being 100 as the date of acquisition. S Limited declared but not paid 10% dividend out of post acquisition, but no entry was made in the books of S Limited and H Limited. So out of 200 rupees, 100 rupees is the capital profit. Balance will be the revenue profit. In that revenue profit, they are offering 10% dividend. So for 400 rupees, if you are offering 10%, then 40 rupees will be the dividend. So now, as such, now they have not transferred provision proposed dividend account from the reserves and surplus. If you transfer, the profit will reduce from 200 to 160. Out of that, 100 is the capital profit, balance 60 will be the revenue profit. And this 40 will be shared between holding company as well as minority interest. Holding company as well as minority interest. So the holding company share being 80%, so 80% on this, 32 is for holding company, 20%, 8 rupees is for the minority interest. Usually it's a post-acquisition profit, right? So in case of post-acquisition profit, it will be added to the profit and loss account of the holding company. This will be included in the minority interest. In case of pre-acquisition profit, it should be subtracted from the cost of acquisition, but here it's not so. You have to understand this. Now, share this to holding and minority interest. 80 rupees is for the holding company, 20 rupees is for minority interest. Similarly here, out of 60 rupees, 20%, 12 rupees is for minority interest. Balance being 60 into 80%, 48 is for the holding company profit and loss account. Okay. Now you can prepare the cost of control as well as minority interest. Cost of acquisition of the shares in this case being 300 rupees. Already 200 taken, so now 300 rupees. Minus book value. 400 is the book value. 80%, 320 is for the cost of control holding companies holding shares. And book value held by the minority interest in this case being 20% on this value, 80 rupees. Apart from that, capital profit should be transferable here, which is 80. And profit for the minority interest, there is no classification as minority, pre or post acquisition here. Directly the 32 will come here. Apart from that, minority interest share 8 rupees for dividend proposed dividend, that should also be addable here. So the ultimate value be 120. And what about this one? This one was taken, also taken. This 48 will be addable with the resource and surplus here. So 600 is the initial value they have. Right. Now they have to add 40 rupees from minority, means a subsidiary company. Apart from that, this 32 should also be addable. 48 and 32. What is the ultimate value? 680. So I have posted all these value. Now try to find out the goodwill or capital reserve here. 400 is the net worth, but payment is only 300. You are paying lesser. Then excess worth will be called as goodwill here. This is goodwill. Is that okay? So in non-current assets, tangible assets, goodwill being 100 rupees. And minority interest, that equity share capital being 1000. Reserves and surplus, we got this value being 680. And minority interest we have which is 120, and debentures remains as it is. Current liability also remains as it is. The tangible assets in this case being 2000, we don't have the investment, and current assets being 1000 rupees. Overall total being 3100. Are you getting this value? Come on. Ah, 2900. Oh, you are getting capital reserve. Sorry, capital reserve. Yeah, you pay lesser, so it is capital reserve. Then this value being 780. Okay. The ultimate total being 3000 rupees. Now see, if you don't consider the proposed dividend separately, what happens? The answer remains the same. The answer remains the same. So usually in case of proposed dividend, either you can leave it untouched or you can pass an entry this way. Okay, that's your choice. Clear? Make a note of it. Now, we'll move on to the next illustration. Dividend partly paid out of pre-acquisition profit, that too credited in P&L account. If the dividend declared out of pre-acquisition profit, it should be subtracted from the cost of control account or cost of acquisition, because it's a returning of your investment. What you invested, you are getting it back. So at the time of investment, you are debiting the investment, you are getting it back, means it should be credited. But in case if it is being the post acquisition profit, then it is your return on investment. What you invested, for that you are getting any return. That return on investment will be a part of a revenue item, can be transferred to the P&L account here. The pre-acquisition dividend received and wrongly credited in the P&L account, so there is a rectification of errors here. Okay. Now, H Limited acquired 80% shares when estimated had 100 rupees in reserves. So, the ratio being 80% as well as 20%. Holding as well as minority in interest. Estimated declared 50%, 10% dividend, of which 50% out of pre-acquisition profit, and H Limited credited the dividend in received in its P&L account. Right. So now reserves and surplus. What about the reserves and surplus? We have 200 rupees. This is what about the total. Now segregate that to pre and post. So pre-acquisition profit being 100 rupees minus dividend declared. Okay, maybe at the rate of 10%. Am I right? 10%. So 10% being 40. In that 40, 50% is out of pre-acquisition dividend. Another 50% is post-acquisition dividend. This is post-acquisition. You don't worry about the post-acquisition dividend, because the post-acquisition dividend should be credited only in the P&L account. They have done it correctly. So the wrong thing happened is only this case. Pre-acquisition dividend was wrongly credited in the P&L account. It should be rectified here. So 20 rupees. After this, the pre-acquisition profit reduces to 80 rupees. So 80 rupees. Out of the total 200 rupees, 80 rupees is pre, then remaining 120 is the post one. So hereafter the illustration will be as usual model. Okay, this 20 can be segregated into holding share as well as minority share. In case of holding share, 80 percentage 16 will go minority interest share 4 rupees. For the minority interest share, we never bother. Okay, we don't have the capital profit, revenue profit classifications in minority interest. This classification available only for the holding company. We purchased and then we realized that the profit already exists before we purchase. So if I am getting any dividend, it's a return of investment. So this adjustment I will do only in the case of holding company. I never bother about the minority, the third parties one. Right. Cost of control as well as minority interest. Let's see. Holding company share, 80% of this, 64. Minority interest share, only 20%, 16. Plus from here, 20% on this being 24. Okay, the overall value will be for the minority interest. 96 is for the holding company. This is the revenue item. This is the revenue item. What you have to do with this 16, sir? This 16. One is adjusted in the cost of control. From the cost of control, cost of acquisition, it should be subtracted. Cost of acquisition, it should be subtracted. And in P&L account, also it should be subtracted. Wrongly, it was credited. To reverse it, it should be debited. Means you have to reduce the P&L account. As well as holding company also, means cost of acquisition should also be adjusted to that extent. Right. Now come on, tell me. Cost of acquisition of the share being 300. What is the net worth? Minus book value of the shares, 400 rupees. Out of that, holding company share being 80%, 320. Minority interest share of equity share capital being 80 rupees. 80 rupees. Apart from that, total value being 40 and holding company share 96. Here we have 600 rupees. 600 rupees. With that, this 96 should be addable. And this 16 rupees should be subtracted from here. Pre-acquisition dividend. And another 16 rupees should be subtracted from the P&L account. Is that okay? Hope now we have posted this one, and this one should be posted twice. We have incorporated that. Now, overall value being 400 rupees, but you paid only 300 rupees, 100 rupees, you paid lesser than capital reserve. For the minority interest, it is 120. What is adjusted profit here? 680, I think so. Is that clear? Now, equity share capital being 1000. Reserves and surplus along with the CR, it may be 780. You can prepare a notes to account like then minority interest 120 and debenture has no adjustment, and this one also be 700 and this is 2000 dash 1000. Okay, what's the value here now? It's now agreeing, right? 3000 is now tallying. Clear? Make a note of it. So with that dividend related adjustment is over. Now let's move on to the bonus related adjustments. Once we complete the bonus related adjustment, the entire adjustments are over. Is that clear? So in this particular chapter, in Singar Academy's book, especially SSA's book, I have included all the basic concepts in simple illustrations form. In your examination, you will have the collective form also. So you have to be double cautious with that. So we'll try to solve some illustration that also. And I already completed the book bag problems. It's available in website. Go and see those book bag problems also for your further reference. If you have any doubt, you can go and refer. See, as already told you, this is the part you have to understand. 5 steps only. Okay, 5 steps only. Calculate percentage of holding by holding company as well as minority interest. Segregate the profit and loss into capital and revenue profit. Calculate cost of control. You will get either goodwill or capital reserve, and calculate minority interest and prepare consolidated financial statement. Majority cases you will get the consolidated financial statement, especially balance sheet. Okay, that cash flow statement and the income statement is for the understanding purpose. Even in CA book, no, they have given the cash flow statement and stating that it is only for the learning purpose, not for the examination. You don't need to worry about that. Predominantly, you will get the balance sheet only. So try to solve a number of comprehensive illustrations also from the balance sheet form, so that you will become master over this. And the core adjustments you have to be master for this particular chapter being dividend related adjustments. So dividend may be out of pre-acquisition or post-acquisition. Just now we completed in detail. And revaluation of assets and liabilities along with the depreciation, without depreciation. These two models you have to cover it. And in case of mutual owings, debtors and creditors, BR and BP, debenture and investments, these are the mutual owings we have. You have to understand how to adjust that. And in case of unrealized profit and unsold stock as well as unused assets, we have two streams, downstreams and upstreams, right? So in case of downstream, it may be adjusted in both the account, means in the holding company, like, and upstream, it may be adjusted in the both the account, like we have seen all these things. The last part that I have to cover here is all about bonus shares. Bonus shares also the same like in dividend. Either it may be announced and given out of pre-acquisition profit or post-acquisition profit. But in case of dividend, if it is given out of pre-acquisition profit, this is called capital profit. And post-acquisition profit, if the dividend is announced out of post-acquisition, this is revenue profit. That okay? Capital profit and revenue profit. Clear? Capital profit and revenue profit. Right. But in case if the bonus share is given out of pre-acquisition or post-acquisition, whatever it may be, both will be considered as capital profit. Both will be considered. So, if the dividend is announced out of pre-acquisition profit, this will be subtracted from the cost of acquisition. Similarly, if the dividend is given out of post-acquisition profit, it will be included in the P&L account. Included in the P&L account. But here, whether the bonus share is given out of pre or post doesn't matter. It will be included as a capital profit and subtracted from the cost of acquisition. That's the beauty of this illustration. See what happens in a typical exam question asked in CMA final once. No, very interesting. If the dividend is distributed out of post-acquisition profit, what happens? If dividend not distributed, what happens? Usually, post-acquisition profit is a part of P&L account. If you are giving the bonus shares out of post-acquisition profit, it is considered as capital profit and adjusted in the cost of acquisition, right? So that will have the impact in the goodwill or capital reserve calculation. But in case of dividend, it will not work, whether you give it or not. If it is pre-given or not given, doesn't matter. The cost of acquisition remains, the cost of control remains unaffected. Okay. If it is given, it may be subtracted from the cost of acquisition. If it is not given, also be subtracted from the cost of acquisition only. But in this case, this is the beauty. If post-acquisition profit is used for the bonus distribution, automatically the amount transferable to the P&L account becomes a part of what? Cost of acquisition, like it should be subtracted in the cost of acquisition. Then automatically you are paying more value like or less value like, then it will have the impact in the goodwill or capital reserve calculation. The same illustration incorporated in the Singar Academy text also. The same question asked in the CMA final level every year. So this is one of the fantastic questions asked in the CMA final. Okay, what happens if the prepare consolidated profit and loss account in each of the following cases? Bonus before issue of bonus shares. If there is no bonus share issue, what can be done? Immediately after the bonus shares. And it may be assumed that the bonus shares were issued out of post-acquisition profit. Okay, post acquisition profit is nothing but a normal profit transferable to the P&L account, but if it is used for bonus distribution, it's a part of capital profit, then it will have the impact in the goodwill or capital reserve. Anyhow, before we go for the comprehensive illustration question number 17, let's start with the basic illustration question number 16. Bonus shares out of, 15. Bonus shares out of pre-acquisition profit. If the bonus share is given out of pre-acquisition profit, no problem, because whether given or not, it's a part of cost of means net worth only. Net worth remains same. Whether you give it or not, net worth remains same. Then goodwill or capital reserve also remains the same. If the bonus is given out of the post acquisition profit, then it becomes a capital profit. Then there will be impact in the goodwill or in the impact of cost of control. There will have the impact in goodwill or capital reserve. Right. On 1/10/21, H Limited acquired 24 shares in S Limited when S Limited had 150 in reserves. Okay. 24 shares. How many shares are there? Out of 400 means 40 shares are there. So 24 by 40, 60%. And holding company, minority interest should be balanced 40%. 16 shares, 40%. And reserves and surplus, 200 being total. Now, S Limited had 150 when 1/10/21 as in the date of acquisition or as in the date of acquisition. Okay, pre-acquisition and post-acquisition. So pre-acquisition profit being $150. Bonus is given from this amount only. S Limited declared 1 bonus shares for every 3 shares held out of pre-acquisition profit. 1 share is offered for every 3 share held. So here 40 shares are there, right? I think I have to make slight correction here. Come on. So the beauty of this illustration is shares held before bonus share, announce the bonus share, then number of shares you have after bonus share. If you are holding 3 shares, 1 bonus share will be given. So the total number of the total number of shares you will have after the issue of bonus share being 4. Clear? 400 rupees, 10 rupees each means 40 will be the overall share as on which date? Year end. Year end means already bonus share declared and it is included here. This 400 includes bonus share also. So 4 is nothing but this 400. Out of that, bonus share being how much? 100 and this share being 300. It means originally they have how many shares? 30 shares only in the beginning. In that 30, holding company holds 24 share, minority interest holds only 6%. It means 80% held by holding company, 20% held by minority interest. So whenever there is a bonus share, this particular component also very, very important. Whether the balance sheet is prepared after including the bonus share, the number of shares available in the balance sheet is inclusive of bonus share or exclusive of bonus share. Right. It may be clearly stated the bonus share is declared and included in the balance sheet itself. It's inclusive of bonus share. Is that okay? Sometimes it may not be stated. Simply bonus share is announced year end, this much share they have. It means it is inclusive of bonus shares. But holding company purchases some shares, no, that's before the declare of the bonus. Then you have to find out what is the number of shares they have before the declare of the bonus shares. In that the holding company shares being 24. It's not 24 by 40, it's 24 by 30 will be the correct one. You have to be careful here. Clear? Now, so for the bonus shares, 100 rupees will be there, right? After bonus share, now pre-acquisition profit is decreased to 50 balance. Then 150 being the post-acquisition profit. This bonus share will be shared between whom? Should be shared to holding company as well as minority interest. Holding company as well as minority interest. This bonus share. Okay. Holding company share being 80 rupees, minority interest share being 20 rupees. Minority interest share being 20 rupees. No need to worry about to include this because this 400 is already inclusive of bonus share. Is that okay? You no need to include them. I will explain that while solving the cost of control. Let's share this for holding and minority. 80 percentage being 40, 20 percentage being 10, and here 30 and 120. So minority interest value being 40, holding company value being the capital profit being 40, and holding company profit and loss revenue profit being 120. Now cost of control as well as minority interest. Cost of acquisition, how much is that? Purchased for 600 rupees. Now add book value of shares along with the bonus shares. Book value of shares along with bonus shares. This 400 includes bonus shares also. So out of that 80 percentage, 320 will be here, and equity share capital including bonus share 80. Actually, it is nothing but 240 plus bonus share 80. 240, 24 shares originally purchased into 10 rupees, 240 plus bonus share 80, 320. Anyhow, in the books, the book value of the equity share capital in the SL company is considered as inclusive bonus share. You no need to add it separately. If it is not stated so, then you have to add. So in the balance sheet, the number of shares in S Limited may be inclusive of bonus share or exclusive of bonus share. You have to be double cautious in that. If it is inclusive, no need to do any adjustment. Then capital profit here being 40, minority interest profit share in this case being 40, and this will be addable with the profit here. So 600 with 120 is added. This is not required to be shown anywhere because it's already included. So 360 is the net worth of our company in the company of S Limited. Yeah, come on, tell me. You will be getting 240 being paid excess. So that 240 is called goodwill. Similarly here, 120 will be the minority interest. Now 720 is reserves and surplus. Let's now post all these values. Equity share capital being 1000. This 400 was already taken. Resource and surplus 720. Go and refer the working note. Not required this anymore. Minority interest 120, and debenture current liabilities being the same value. And in non-current assets, we have intangible assets, goodwill 240. I post this. And then tangible assets, no change. I just add these two values. Investment was already cancelled while calculating the goodwill and capital reserve. Current assets being 700. What's the ultimate value here? 2940. Here, now it's agreed. Hope now you'll be able to understand the logic of bonus shares if it is declared out of pre-acquisition profit. What happens if it is declared out of post-acquisition profit? Let's see. If it is clear, text me, so we'll move on to the next one. Question number 16 is all about post acquisition profit. H Limited acquired 24 shares and S Limited had 150 in reserves. One bonus share was issued for every 3 shares held out of post acquisition profit. Out of post acquisition profit. Now, bonus equity share capital before bonus share, and bonus share offered, then equity share capital after bonus share. If you hold 3 shares, you will get 1 additional share, then you will be getting 4 shares. Currently, 40 shares are there, definitely 10 bonus shares will be there beforehand, 30 shares may be held. 24 shares are held by H Limited. So out of that, 24 held by H Limited and balance held by minority interest. So 80% by holding and 20% by minority interest. Clear? Now reserves and surplus 200 rupees in total and for pre as well as post. 80 20 160 and 40 80 20 80 20 160 and 40. Sorry, pre is how much? 150 is the pre. Okay, 150 and 50. Sir, what about the dividend means bonus share distribution? Sir, never bother about that. Was already done, subtracted from the post acquisition. This post acquisition profit is left over post acquisition profit only after distribution of the bonus share. Maybe 150 may be the bonus post acquisition profit. From that, already 100 rupees bonus share is declared. Balance 50 is available here. This 50 is this one. This 100 already included here. So you no need to do any adjustment. Okay, in case of pre, you need to find out what is the pre after the bonus share. But in case of post, the leftover value is the post acquisition profit after the bonus share. You don't do any more further adjustments here. Clear? So the sum seems to be pretty simple if it is being the post acquisition profit bonus. And share between holding and minority. 150. 80% here 120. 20% is 30. In that 50, 20% being 10, 40 being holding company share. Minority interest value, holding company value. Is that okay? Holding company value. Now we can calculate cost of control as well as minority interest both. Cost of acquisition. The cost of acquisition of share being 600. This 200 also taken. Minus net worth, equity share capital including bonus share. This 400 is inclusive of bonus share. So out of 400 rupees, 80% is held by H company, 320. Balance is held by the minority interest. So equity share capital along with the bonus share for the minority interest being 80. Capital profit being 120 and profit for the minority interest in this case being 40. And this one 40 will be addable with the profit. So 600 plus 40 reserves and surplus 640. So the net worth in this case being 440, but you paid 600 rupees, 160 excess payment named as goodwill and minority interest 120. Now equity share capital being 1000 remains as it is. Reserves and surplus, we have to take it from here 640 and minority interest 120 and debentures 400, current liability 700 goodwill 160, 2000 tangible assets dash, and this will be 700, 2860, 2000. Okay, clear. Text me.